Hello and welcome to Lecture 4 in our series of Introduction to Financial Accounting lectures. This lectures series is brought to you by the team at BNO Chartered Accountants, Dublin, Ireland. In this session we will introduce the accounting cycle. The accounting cycle is the process that culminates in the production of a set of financial statements for a business. With the advent of financial statement production software, these steps are all now automated, but for various accounting courses and professional accounting examination requirements, you must know the various steps involved and be comfortable with preparing various journal adjustments. The accounting cycle is a systematic process that begins with recording transactions and ends with preparing financial statements. It ensures accuracy and consistency in financial reporting. The key steps are: recording transactions, making adjusting entries, preparing the trial balance, preparing financial statements. We'll discuss each of these steps in this order. Recording transactions is the foundation of the accounting cycle. Every financial transaction is documented in the books of the business. The combined set of ledgers that make up the accounts of a business is generally called the nominal ledger. Each transaction is individually recorded in this nominal ledger, from bank receipts and payments, sales of goods and services, purchases of goods and services, and journal adjustments, which we will discuss later. The most important thing to note is that each entry has a debit and a credit, maintaining the double entry principle. For example, a cash sale is recorded as follows: debit, cash; credit, service revenue. This ensures the accounting equation, assets equals liabilities plus equity, remains balanced. Adjusting entries are non-routine transactions that often arise from management estimates or other entries that are required because of the adoption of the accruals basis of accounting. For example, the following journal is required to be made to record income earned but not yet received. Debit, accounts receivable. Credit, revenue. A journal adjustment is also required for depreciation, which is simply an estimate of the notional cost of the wearing out of an asset over a certain period of time. Debit, depreciation expense. Credit, accumulated depreciation. These adjustments provide a more accurate financial picture of the financial performance of the business. The following are a couple of common examples of further journal adjustments. After all transactions have been recorded and all journal adjustments made, all the account totals are extracted and placed in a tabular format to come up with the trial balance. A trial balance is a list of all ledger account balances to check that total debits equal total credits. It's prepared at the end of the accounting period to ensure there are no mathematical errors in the ledger. When total debits and credits match, the trial balance is balanced, and we can proceed to the next step. This slide shows an example of a very simple trial balance. The debit side shows assets in the balance sheet and expenses in the income statement. The credit side shows liabilities in the balance sheet and income in the income statement. The final step in the accounting cycle is preparing financial statements. These statements summarize the financial performance and position of a business. Income statement reports revenues and expenses to show profit or loss. Balance sheet provides a snapshot of assets, liabilities, and equity. Cash flow statement tracks cash inflows and outflows during the period. The The individual account totals in the trial balance are extracted and recorded in the income statement and balance sheet in the format required by the regulatory framework the business is required to report under. Remember, we discussed this in Lecture 3 of our series, where we discussed the two regulatory frameworks of IFRS and Irish and UK GAAP. The following two slides show very simple examples of an income statement and balance sheet. The key takeaways from this lecture are: individual transactions accumulate to form account totals. Journal adjustments combine with prior transaction totals to form account balances. Account totals are extracted in tabular format to derive a trial balance. The trial balance is used as the primary source of information for the composition of the financial statements. Thank you for reviewing Lecture 4 in our series of lectures on Introduction to Financial Accounting. We hope you found this session useful, and please like and subscribe to our channel for more future content like this.